Welcome back to our reading on long-lived assets. So our first learning outcome here asks us to describe the revaluation model. Now, straight away, we should say revaluation of PP and intangibles can only apply to under IFRS, not US GAAP. So notice US GAAP says you need to use depreciated historic cost for your intangibles, your PP&E. IFRS, however, gives us a choice. We can use depreciated historic cost, but alternatively, we can choose to record our assets, our PP&E and our intangibles at their fair value. Okay, now, in other words, this adjustment to fair value we describe as a revaluation. Now, we're talking about revaluations here below historic cost and above historic cost. Let's talk about a revaluation below historic cost first of all. So here, the fair value has fallen below historic cost. Now, notice the balance sheet asset is reduced to fair market value. So it's reduced to its fair value. The amount below historic cost is taken to the income statement as an expense, essentially as a loss on this asset. Now, if in subsequent periods the fair value of the balance sheet asset increases, goes back above historic cost, then we can reverse the loss. Now let's imagine that we bought, let's say we had the historic cost at, let's say, 100 million. Then essentially it declined down to 80 million and then recovered to, let's say, $120 million. Okay, now again, it would be under IFRS, so it would be euros or maybe sterling, etc. Now notice what we have here is our original cost of 100 million. We've then got a decline in fair value. That means we're going to take 20 million and that's going to go to the income statement as an expense. But then in the next period it recovers. Now, now notice it more than recovers. It not only goes back to 100 million, but it goes actually up to 120 million. Now, what that means is of that 40 million, 20 million of it can be shown in the income statement, reversing the previous loss. The further 20 million, taking it up to 120 million, must go direct into other comprehensive income. Now, OCI, other comprehensive income, is essentially a component of stockholders' equity. So what this is just trying to say to you is, look, if you get fair value going below historic cost, then essentially the amount below historic cost gets expensed as a loss in the income statement. If the asset subsequently recovers, we can reverse the loss in the income statement, but we can't show anything beyond the reversal of that loss. In other words, I don't take the full 40 million in my example through the income statement. I take the reversal of the 20 million loss through the income statement. The additional 20 million goes direct to stockholders' equity. Okay, so you can see that as well. Revaluation above original cost, any amounts above original cost go directly into stockholders' equity within other comprehensive income. So here maybe, I bought the asset for 100 million. It's gone up to 120 million. So I increased the carrying value of the asset by 20 million. The other 20 million goes direct into other comprehensive income, a component of stockholders' equity, remember. Now, very important here, we're asked to explain impairments of long-lived assets. Very, very important, because I really want you to be thinking subjectivity. At best, these numbers are subjective. At worst, they are totally made up. Very, very difficult to verify these numbers, to audit these numbers. So we just need to be very, very careful about them. Now, IFRS says you need to annually assess for any indications of impairment of an asset, such as it declines in market value or physical condition. So declines in the physical condition of the asset. One thing we used to do is when I spent some time as an auditor, we'd go around the machinery in a factory and see how much dust is on the top of it. More dust implied it wasn't being used very much and therefore maybe it should be impaired. Now, what is an impairment? Here's our second bullet point and the most important one here. An asset is impaired when the book value, remember that just means balance sheet value, okay, and of course the balance sheet value is historic cost minus accumulated depreciation. So when the book value is greater than the asset's recoverable amount. Now, recoverable amount, what does that mean? That's the higher of two figures. So recoverable amount is the greater, notice greater, of two figures. Fair value less selling costs. So the current fair value of the asset less any costs to sell it, or value in use. Now this is where things start to get wildly subjective. Value in use is the present value of the cash flows that would be generated from using and selling this asset at the end of its useful economic life. Now again, unless you've got some kind of clairvoyance, how on earth do we know what these figures are? So at best, it's an estimate. So value in use, very, very subjective as well. I mean, let's face it, fair value minus selling costs is fairly subjective, but value in use, very, very, very subjective. So we do need to worry about these. Now, if we've got an impairment, then we just write the asset down to its recoverable amount. So down comes the asset to recoverable amount in the balance sheet. The other side appears as a big expense. Again, typically an unusual or infrequent item if it's material. Now, under IFRS, if the recoverable amount subsequently improves, in other words, the value of the asset increases, fair value increases in a subsequent period, we can reverse the impairment up to the original loss. Okay, so fine. So loss reversal is allowed. Now remember what we said in an earlier reading. Typically, IFRS is worried about economic substance. Therefore, if fair value is recovered, it wants you to be able to report this. Now remember, US GAAP is normally more worried about, it's more of an objectives-based, rules-based system, so typically doesn't allow you to reverse things like impairments. US GAAP more worried about it being used for fraudulent purposes. Hey look, I want to move some profit from this year into next year. Why don't I impair an asset this year and then reverse the impairment next year, and I've just shifted a load of this year's profit into next year. So US GAAP very worried about that, and therefore typically does not allow reversals of impairments. So let's have a look at US GAAP. It's a two-step process under US GAAP. Two-step process, first of all to identify whether there's been an impairment and then to measure it. So let's have a look at identification. The asset is impaired when the book value, again balance sheet carrying value, is greater than the asset's undiscounted future cash flows. So this is the cash flows that the asset will generate over its life and on disposal. Now again, how on earth do we know what these cash flows are going to be? It's a complete estimate of what these are. What we're really saying is it's down to the management of the company to say that whether there's been an impairment, and it's down to the auditors to kind of verify this, or more particularly to check that there hasn't been impairments if the management have failed to impair stuff. Okay, so very, very subjective, point one. Now, if there has been an impairment, in other words, the value of the asset is now essentially, the carrying value of the asset is greater than the undiscounted cash flows from use and disposal, then we move on to step two, loss recognition. Now, we're meant to write down the asset to its fair value. Now again, here's the difference with IFRS. IFRS said the greater of fair value minus selling costs or value in use. Here, we use fair value if that fair value can be established. Notice it's fair value, it's not fair value minus selling costs, it's just fair value. Now, if you don't know fair value, because it's not an actively traded asset, there's no way of establishing what fair value is, then we use the discounted value of the asset's cash flows from use and disposal. In other words, discounted value of cash flows from use and disposal, pretty much what IFRS calls value in use. Now again, we recognize the loss in the income statement. Now notice, under US GAAP, there's the key, loss reversal prohibited for assets held for use. Now again, assets get two classifications. Held for use, these are assets that we're using in the day-to-day business operations, i.e. our infrastructure, and assets held for sale. These are assets that are going to be sold on. You may well have an asset that is held for use. Once you decide to dispose of that asset or stop using it, it comes out of assets held for use and goes into assets held for sale. Rule is you are not allowed to reverse under US GAAP the impairments on assets held for use. Assets held for sale, actually the rule is different and you are, but I wouldn't get too worried about that. So here is our assets held for sale under IFRS and US GAAP. Notice an asset is, number one, tested for an impairment when it's been transferred from assets held for use to assets held from sale. In other words, you've got an asset, you were using it in your day-to-day business operations as part of your infrastructure, you've now decided to dispose of it. It comes out of assets held for use and into assets held for sale. At that time, it triggers an automatic impairment review. Now, when we have assets sitting in assets held for sale, notice we no longer depreciate. Depreciation was all about spreading costs over future benefits. Now, if we've decided to dispose of this asset, there are no future benefits. There's nothing to spread the cost against, so we stop depreciating. Now, again, notice the asset is impaired if the book value, the carrying value, is greater than net realizable value, which is fair value minus any cost to sell. Okay, if it's impaired, we write down the asset to net realizable value. Fine. Here's the big surprise, really. IFRS allows you to revalue or reverse any impairment loss. No surprise, IFRS is more flexible, does like you to report economic substance. So it allowed us for most of our impairments, including assets held for use. But here's the shocker, US GAAP does. So in terms of impairments and write-downs, if I was asked in the exam, are you allowed to reverse, then my basic gut feel would be under IFRS, I would say probably, and under US GAAP, I'd probably say no. The only exception under US GAAP is essentially here on assets held for sale. Okay, let's have a little look at an impairment example. A few little numbers here to run through. So we've got machinery owned by Milano Company. Cost 500,000, accumulated depreciation 350 to date, so it's got a carrying value of 150,000, of course, at the current point in time. Book value, balance sheet value 150. Expected future cash flows 145,000, fair value 140,000, value in use, and remember value in use is essentially the present value of those future cash flows, 130,000, selling cost 20. Significance of the selling costs? Well, under IFRS, I need to look at fair value minus selling costs, of course. Under US GAAP, remember, I don't take into account the selling costs. Okay, so let's calculate the impairment loss under both IFRS and US GAAP, if there is one. So first of all, our book value. Well, book value, we've already said, gross cost 500,000, accumulated depreciation at the current point in time 350, giving us 150,000. So 500,000 minus 350. Recoverable amount. Now under IFRS, it's the greater of our two amounts. The greater of fair value minus selling costs, or of course value in use. Now fair value minus selling costs in here is 140 minus 20, so 120,000. Value in use 130,000. We're going to use the higher. So value in use in this case is 130,000. And fair value minus selling costs, of course, is 140 minus 20, so 120,000. So we're going to go with essentially the value in use, the present value of the future cash flows. So 150 minus 130 brings us down to an impairment loss of 20. So we're going to reduce the assets value by 20,000 in the balance sheet. So it's now reported at 130,000, and that 20,000 appears as an expense, reducing net income as an unusual or infrequent item in our income statement, of course. Now let's turn our attention to US GAAP. Two-step process, remember. First of all, we need to compare the carrying value of the asset, the 150,000, to essentially the undiscounted cash flows from use and disposal. So carrying value of the asset 150,000, expected future cash flows 145,000. So our carrying value is indeed above the expected future cash flows. So we have an impairment. We move to step 2. Now step 2 says compare book value to fair value. Remember, we only use value in use here if we cannot establish fair value. So book value 150,000. Fair value, we don't deduct selling costs, so it's 140,000. So the impairment loss here is 10,000. So notice in this situation, lower impairment costs simply because of the selling costs that are not deducted under US GAAP from fair value. Derecognition of a long-lived asset. So we're asked to explain derecognition of a long-lived asset. So what's this? Disposal of a long-lived asset. That's what we mean. Now, when we dispose of a long-lived asset, we're going to remove any trace of it from the balance sheet. So we're going to remove its cost and we're going to remove its accumulated depreciation. That comes out of the balance sheet. We no longer have the asset. We can't keep these items. And instead they're going to be put into the income statement. Now actually let's have a look at what the accountants do. What they do is they compare proceeds, the proceeds we get on disposal, to the carrying value at the moment of disposal. Now of course the carrying value at the moment of disposal is made up of those two elements, the historic cost and the accumulated depreciation. So proceeds compared to the carrying value at the time of disposal, and that gives us our gain or our loss. If the proceeds are bigger than the carrying value, the balance sheet carrying value at the time of disposal, hey, we've got a gain, and if the proceeds are smaller, we've got a loss. Key point to note, therefore, is that the gain or loss hitting the income statement on an asset disposal is not a cash flow figure. It's not cash. The proceeds, these are the cash figure, not the gain or loss on disposal. In fact, the gain or loss on disposal is essentially the proceeds less the carrying value at the time of disposal. Implication, of course, is if we disposed of an asset for its carrying value, so let's imagine it's recorded in the balance sheet at 200 million and we dispose of it for 200 million, there'll be no gain or loss on disposal. Now, what about assets that have been abandoned? Well, we do exactly the same calculation. If we abandon or scrap, or if you like, or an asset, all that happens is that the sales proceeds are zero. So when we look at our computation, proceeds less our carrying value, and that giving us our gain or our loss. So when we actually abandon an asset, all we're doing is replacing this figure here, the proceeds, with zero. So automatically, of course, we're going to get a loss. And that loss will simply be the carrying value at the point that the asset is disposed of. So that automatically, of course, would give us a loss. If it's exchanged, well, all we do, part exchange, is the proceeds become the fair value of the asset that we've received in an exchange. Again, if we're disposing of significant assets, then the purpose, the reason for disclosure, of course, should be discussed in the management discussion and analysis. We'll also see disposed assets being disclosed, the amounts being disclosed in the footnotes. Assets held for sale. Remember, these are really assets held for use. Once we decide to dispose of an asset, it comes out of assets held for use and into assets held for sale. Okay, fair enough. The impact of derecognition, well, we said, look, we're removing two things from the balance sheet. We're removing the historic cost and the accumulated depreciation. The asset no longer exists. We've got to get rid of these items. Okay. Cash, notice, so if it's sold, we're going to remove the asset. If it's exchanged one for another, the old asset's being removed and the new asset is being replaced. New assets coming in. And remember, we said in a part exchange, we'd do that at fair value. A gain or loss, of course, is reported in the income statement, being the difference between the proceeds received and the carrying value at the date of the disposal. When an asset's abandoned, of course, yes, we remove the asset from the balance sheet, but this time it's always going to be a loss in the income statement. The computation's the same, it's just that the proceeds figure, of course, is zero. Now, our LOS is really asking us here to explain and evaluate impairments, revaluations, and derecognitions. So here's our balance sheet, of course. We're talking about revaluation first of all. So what about a revaluation? An increase in an asset gives us a higher carrying value in the balance sheet, assuming that the fair value of the asset's increasing over time, of course. Okay, so you get a higher carrying value of the asset. Now, let's imagine that we bought our asset for 100 million. It's gone to 120 million. Now, of course, we increase the carrying value of the asset now to reflect the fair value, 120 million. So balance sheet assets increased by 20 million, but something else has got to increase. And of course, we said it is going to be our stockholders' equity. We're going to have a revaluation gain in our other comprehensive income. Remember, other comprehensive income is all of the gains and losses that do not hit the income statement. Okay, so we'll essentially increase our other comprehensive income by 20 million. Look, if assets have gone up by 20 million, equity needs to go up by 20 million to keep the balance sheet balancing. Impact on the income statement when we revalue PP&E and intangibles, no impact whatsoever in the current period. However, in future periods, future net income, notice, is decreased. Why? Bigger carrying value now in the balance sheet to depreciate. So you will find greater depreciation. Cash flow, no impact at all. The only cash flows on assets are when we buy them and when we sell them. So here we're talking about unrealized gains and losses. We still hold the asset balance sheet year-end date. It hasn't been sold, and therefore these are purely non-cash items. So no impact on the cash flow statement. We would expect, though, the revaluation, if it's significant, to be discussed in management discussion and analysis, and of course disclosed in the footnotes. And we'll talk about footnote disclosure in a second, what we'll actually see there. If we are going to revalue assets, we need to see not only the revalued amount, but what it would be if we'd used an historic cost method. And this gives the analyst the information to switch between revaluation and historic cost approaches. Okay, the impact of upward asset revaluation on our ratios, of course, fixed asset and total asset turnover ratios, so sales over either just fixed assets or sales over total assets. Well, of course, sales unaffected, assets are going to be higher, and therefore overall the ratio is going to decline. Debt to equity ratio, debt over stockholders' equity. Debt, interest-bearing liabilities, well, that's not affected by revaluing your assets, but equity, of course, is going to go up. Why? The other side of the revaluation, the unrealized gain, if you like, gets taken directly into stockholders' equity within that other comprehensive income. So more equity, so overall, our ratio is going to decline. Current year return on assets and return on equity. So return on assets, net income over assets. And of course, return on equity, net income over equity, if we revalue. Now, of course, if we revalue, up goes assets, up goes equity. Net income, unlikely to be affected in the current period. So let's leave it relatively constant. It could decline a little bit. We'll explain why in a second. But essentially, it's all about the denominator in the current period. So higher assets, higher equity, and therefore we're going to see both ROA and ROE decrease. But in future, of course, net income over assets or net income over equity, in future, of course, we're going to see the net income being adversely affected. If you revalue, there's now more sitting in the balance sheet needing to be depreciated, and therefore you're going to get lower net income if under a revaluation model in future periods. More depreciation now passing through the income statement. So, of course, your assets and your equity are also higher due to the revaluation. Net income is lower, so these ratios are definitely going to take a hit. So notice asset revaluation. Quite nicely, a leverage ratio reduces leverage. Not so great for asset turnover or return on assets and return on equity. Now, let's turn our attention to impairments that we also need to be able to discuss here. Now, balance sheet, key point is the impairment is reducing the asset down. Okay, so yes, lower carrying value of the asset in the balance sheet. That is the impairment. Of course, the other side of the impairment hits the income statement. It reduces net income. Remember, it's an unusual or infrequent item if material. It's going to reduce net income. If it reduces net income, it reduces, of course, retained earnings. And if retained earnings are lower, stockholders' equity is lower. So our equity is going to be lower too. In the income statement, remember the impairment charge, unusual or infrequent item, reduces this year's net income. So you've got a bigger expense reducing our net income. But notice, in future periods, lower depreciation. Why? There's less balance sheet carrying value, asset figure is now smaller figure, less depreciation going forward. So notice lower depreciation and therefore higher earnings in future periods. Implication here, and we've actually put it in brackets, potential for earnings management. So situation, maybe a new management director, managing director, CEO, whatever, has come into the company, charged with turning the company around. First thing they do is depreciate or impair all of the assets. Then in the second year, obviously in the year of impairment, that's going to give you big impairment losses. But of course they turn around and say, look, we've only been here for a little while, not really down to me, it's more to do with the outgoing management team. Then in the subsequent year, of course, there'll be less depreciation. Once you impair those assets, their carrying values are lower, there's less depreciation, and therefore earnings will improve, and of course they'd take the glory. So be careful, they can be used for earnings management, either by impairing to get the benefits in future periods of less depreciation, or of course, under IFRS, with an impairment, you can impair an asset and you can reverse it in a subsequent period, shifting profit from one period to the next. Cash flow. Well, look, cash flow, unaffected. Impairments are non-cash charges. Now, again, a question that's come up in class quite a bit is, well, what about tax? Are they allowed in the tax returns? And the answer simply is no. Look, these things are so subjective. There's no way the tax authorities are going to allow you to, number one, identify whether there's been an impairment, number two, identify the size of it, and then save yourself some tax on it. So they are not allowed in the tax return, so they don't have any implications on tax either. So in fact, the cash flow is completely unaffected by impairment. Disclosure, well, significant impairments, I'm going to want to see the reason for it disclosed in the management discussion and analysis, and of course, again, the footnote disclosure as well. Impact, let's have a look at the impact of our impairments. Fixed asset and total asset turnover ratio. Sales, well, of course, unaffected. Assets, well, it's going to reduce the carrying value of our assets. So in fact, fixed asset and total asset turnover ratios are going to improve with impairments. Debt to equity, debt unaffected, not going to affect equity. The impairment, of course, hits the income statement. It reduces net income. That reduces retained earning. That reduces stockholders' equity. So equity is going to go down, and therefore our leverage is going to increase. Current year ROA and ROE, net income over assets, or net income over equity. Current period, in the year of the impairment, massive hit, of course, on net income, but also, of course, with an impairment, you're going to see a drop in assets and equity as well. So there is impact on both the numerator and denominator here. Again, largely we would expect our numerator to dominate. So proportionally, the numerator is going to take a larger hit than the denominator. So therefore, typically ROA and ROE are going to decline. But of course, in subsequent periods, then you're going to benefit because your net income is going to be higher because there's less depreciation, and yet your assets, of course, assets or equity, I'm going to combine the two together, your equity and assets are essentially lower from the original impairment. So you've got a big impact on the numerator, lower assets and equity, so higher in the future. Right, so analysis of impairment. Now, good point, this one, I like the first point. If we've got an impairment, past earnings have been overstated. Why is that the case? Well, past earnings must have been overstated because the carrying value was above fair value. And if the carrying value is above fair value, it's an indication that we've failed to depreciate the asset by a sufficient amount. So it's an indication, therefore, that depreciation was insufficient in previous periods and therefore earnings were overstated. Now again, yes, look, management has some control over the timing and the size of impairment losses. It has massive. Remember the two-step process under US GAAP. In order to identify the impairment, they compare carrying value to the undiscounted future cash flows from this asset's use and disposal. Completely made up number. Okay, so lots of scope here to potentially manipulate at the very worst, or at least to be inaccurate with your estimates here. So lots and lots of subjectivity in impairments, and that of course means it's a very examinable topic for analysts. Impairments involve judgment, potential earnings management. Yes, as we said, creating an impairment and reversing it is one way to manage your earnings, and that's allowed under IFRS, but not US GAAP because you can't reverse. But also impairment reduces future depreciation and therefore gives you a boost to your earnings going forward. So think about the earnings management, very, very key in here. Consider revising earnings and cash flow forecasts. Well, again, if there's been an impairment, then of course, maybe we should be revising our forecasts downwards, essentially. Disclosure requirements for our fixed assets. Again, we just need to be aware of them. Carrying value. So remember, carrying value simply means balance sheet value for each different class of asset. Accumulated depreciation or amortization, again, by each different class of asset. Title restrictions and assets pledged as collateral. Title restrictions, of course, would be anything that would stop you from selling an asset on, anything preventing you from selling an asset on, legal title. And assets pledged as collateral, in particular, for debt obligations. So maybe I've issued a bond, and as security for that bond, I've secured it on my land and buildings, meaning I'm not allowed to sell off my land and buildings before retiring my bond. So there's a title restriction there because I can't sell off my land and buildings. Now the idea, of course, is it acts as security for the bond. If I was to default on interest and principal payments, the bondholders could sell off this asset and use the cash flows generated to pay off their principal. So any title restrictions and assets pledged as collateral in relation to your debt obligations. For impaired assets, the loss amount, so the total amount that's hitting the income statement, and the circumstances. Why was there an impairment? Remember, it's all about value in use or fair value declining below book value. What has caused this? Has there been a change in your market conditions? And of course, that change in market conditions is why we might downwardly adjust our earnings on the previous slide. For revalued assets under IFRS, notice they have to say when revalued, how fair value was determined, but again, and I think this is a significant one, what the balance sheet value would have been under the historical cost model. So in other words, if you hadn't revalued and instead carrying value was based on historic costs less accumulated depreciation. This last point gives the analyst the data they need if they want to adjust a company from revalued amounts back to historic cost. And again, that might be useful if you're comparing ratios between two companies. A little bit on using fixed asset disclosures. We're asked to analyse and interpret fixed asset disclosure. What we're going to do here is some very rough and ready computations. They are very, very approximate, but we're going to try and approximate average age of our fixed assets, average depreciable life. In particular, what we're trying to work out is assets that are close to the end of their life that need to be replaced, because of course that's going to lead to big cash outflows for the firm, affecting things like free cash flow and our valuation of them. So we're going to try and identify firms with older assets because of course two things. Number one, they're inefficient perhaps, so it might be having an impact on the earnings potential of the company. But number two, if it's got old assets, they're going to need to be replaced, large capex flows, and of course lower free cash flows and therefore lower firm valuations. Also, of course, notice to identify firms with inflated earnings, because if you've got low asset values, low carrying values in the balance sheet, there's less depreciation in the income statement, and lower depreciation in the income statement, higher earnings. So we need to be aware of that as well. So here are three very rough and ready computations. Estimated useful life, take historic costs, sometimes referred to as gross PP&E, in other words, really your purchase price, minus the annual depreciation. That's going to tell you roughly the life of the asset. Now again, notice the assumptions that we're really making here. We're assuming straight line depreciation has been used, and number two, we're assuming that salvage value is at best negligible. If salvage value is significant, then again there's going to be errors in these computations. So they are rough and ready. Estimated life, take the accumulated depreciation so far over this year's depreciation expense, and that will tell you how many years worth of depreciation has been charged to date. And estimated remaining life, net PP&E, which of course is cost less accumulated depreciation over the annual depreciation expense. Or if you like, estimated useful life minus estimated age, and that gives us our remaining life. Okay, investment property. Yeah, first of all, it is IFRS only. So what are these? These tend to be buildings that you own, land and buildings that you own, purely for either their rental potential or their capital appreciation. So it's not really infrastructure. You're not using these buildings to run your business. It's really more of an investment, essentially. Now, IFRS says you need to classify this as a separate type of long-lived asset, and it should be disclosed on the face of your balance sheet. In terms of the carrying value, two methods proposed: either the cost model, which essentially is historic cost less accumulated depreciation, so really the same as we've seen before, or a fair value model. Now be a bit careful, because this is slightly different from our revaluations earlier. So previously, when revaluations took fair value below historic cost, we reported that in the income statement, but when a revaluation went above historic cost, the amount in excess of historic cost was taken directly to stockholders' equity. Here, under investment property, whether you've got a gain or a loss caused by fluctuations in fair value, it all goes to the income statement, even amounts in excess of historic cost. So in other words, it's treated more in line with a trading security, a trading investment, than it is a fixed asset. Notice as well, disclosure of fixed value, of fair value, and how it's been generated needs to be determined. Last little bit here is lease versus purchase. Explain and evaluate how leases affect the financial statement. And essentially, two types of leases, which we're going to discover later on when we look at accounting for the liabilities in more detail. A finance lease, sometimes referred to as a capital lease, where we record an asset and a liability even though we don't own the asset. And an operating lease, where there is no balance sheet recognition of either asset or liability. Significance of our operating leases is these are essentially off balance sheet finance. Probably the biggest source of off balance sheet finance we still have under both IFRS and US GAAP. You're using an asset in your day-to-day business operations, but that asset doesn't appear, nor does the commitment to make rental payments appear, even though you've got a commitment to make payments, and that means outflows of benefit, and of course that's the definition of a liability. So very controversial are operating leases. Let's start with finance leases. Okay, now what we're trying to replicate in the accounting here is the substance of actually borrowing money and purchasing an asset. So we are going to record a liability and we are going to record an asset, essentially. Okay, now the asset's going to be recorded, it's going to be put into our PP&E with all of our other long-lived assets, and it's going to be depreciated. A little bit careful, we need to depreciate now over the life of the lease rather than the life of the asset. So you might have an asset that has a useful life of 10 years, but we're only leasing it for 8, well you need to depreciate it over 8 years because for the final 2 years we don't own it. Second thing we need depreciating, typically salvage value is 0 because you don't own the asset at the end of its useful life. Okay, so we're going to create an asset. We're also going to have a liability. This liability is going to be almost like a debt instrument that's going to be sitting, and it's actually going to be split between current liabilities and long-term liabilities. Now initially the asset and liability will equal one another. They equal one another right at the inception of the lease and right at the end of the lease, but don't necessarily equal one another during the lease's life. We'll see the asset has its own double entry, the liability has its own double entry. The liability will be recorded at the present value of the payments that you're going to make under the lease. And this is an interest-bearing liability. We're going to pay off principal and get charged interest over the life of the lease. So we're going to have a liability. It's going to be amortized over time, meaning essentially that liability is going to decline down to zero, because when we make our final payment under the terms of the lease, we've extinguished our liability. As we said, every time we make a payment, part of that will be interest and part of it will be principal. Okay, and of course the liability falls by the principal element each period as well. Good. So what are we going to see going through the income statement under an operating lease? Two things. Interest, essentially charged on the liability, and depreciation of the asset. Now under an operating lease, now notice we report it as if we're renting an asset. Significant. No asset, no liability on the face of our balance sheet. Now all that's going to happen is every time we make a rental payment on this leased asset, we're going to put the rental payment through our income statement as a rental expense. So it's going to reduce net income, and of course in the balance sheet our cash drops by the rental payment. But that is the significant line. Operating leases, no asset, no liability on the balance sheet. No asset, no depreciation. No liability, no interest. Instead, of course, we've got a rental expense appearing in our income statement each period. Okay. Now, assets and liabilities will be lower than with purchase or a finance lease. Absolutely. There is no asset or liability. So therefore, assets and liabilities must be lower using the operating lease distinction. So again, we need to be able to compare our financial statements and how they affect the our finance leases versus our operating leases and how they affect the financial statements. So under a finance lease, we do report an asset, so our assets are higher. Under an operating lease, we don't report an asset, so relatively speaking, our assets will be lower. Under a finance lease, we do report a liability, so we get higher liabilities. Under an operating lease, we don't, so comparatively lower liabilities. Net income in the earlier years. Typically, we find it lower under a finance lease and higher under an operating lease. In other words, now what I should say here is the total expense on a leased asset that hits the income statement is the same for both a finance lease and an operating lease over the life of the leased asset. However, we do have timing differences. What we typically find is depreciation plus interest, which of course is what goes through the income statement on a finance lease, is greater than the rental payment that goes through an operating lease in the earlier years. But in the later years, that's going to reverse. So depreciation plus interest in the later years is going to be less than the rental payment. Now, one large element of this is because the liability falls over time as we pay off the principal. And as the liability is falling, the amount of interest, therefore, that we're charging on that liability is dropping. So a lot of this is because interest expense declines over the life of the lease. Okay, so notice, therefore, it's higher under a finance lease net income in later years and lower. Again, over the total life of the asset, the impact on net income is identical under the two methods. In other words, we're spreading exactly the same amount of the expense through the income statement over the life of the asset. It's just the timing that differs. Cash flow from operations, significance here, higher under a finance lease. When we take our payment each period, we're going to split that payment between interest and principal on a finance lease. The principal element, of course, is going to affect, well, it's like if you're paying off principal, it's like you're paying off debt. So that's going to affect cash flow from financing. The interest element, of course, affects cash flow from operation. Again, we're rather assuming US GAAP classifications here. Whereas under an operating lease, the rental payment all passes through cash flow from operations. So you're going to get a lower CFO under an operating lease and a higher CFO. Only the interest element passes through on a finance lease. Cash flow from financing, though, as we said, that is going to be lower because of the principal element passing through CFF. Under an operating lease, everything passes through CFO, so comparatively speaking, higher cash flow from financing. Total cash flows identical under both methods. On to look at a few leases. Asset turnover, sales over total assets. Well, of course, sales are going to be unaffected by the method you use, whether you're using an operating lease or a finance lease. It doesn't affect your sales, but of course, assets are affected. Under a finance lease, we've got a higher asset and therefore, of course, lower asset turnover under a finance lease. Return on assets, net income over total assets. So net income over total assets. Now, of course, certainly in the earlier years here, net income under a finance lease is lower, of course, because of the depreciation and interest being slightly bigger than the rental expense. And of course, assets are much higher. So lower net income, but higher assets. Overall, only one way this ratio can be going, and that's down for a finance lease. So lower under a finance lease, higher under an operating lease. Return on equity, net income over, of course, stockholders' equity. Again, net income is going to be the driver of this one. Lower net income. Equity, of course, is slightly lower because net income is lower and therefore retained earnings are lower. But again, of course, the key point here is for a finance lease, overall, that's going to give us a lower ratio. Okay. Debt to assets. Well, it's debt over assets here. Let's think about it under a finance lease. We are recording debt and we are recording, of course, assets. Now, both debt and assets are going up. So we've said under a finance lease, that is likely to make the ratio higher compared to an operating lease. What we're saying is numerator is likely to increase proportionally by a larger amount than denominator. Why? Think of the balance sheet equation, essentially. Assets equal liabilities plus equity. So assets are a proportionally bigger figure than liabilities, and debt is a component of liabilities. So we're increasing both assets and liabilities by the same monetary amount. That's going to have a bigger proportional amount on debt, a bigger proportional impact on debt than it is assets, and therefore a higher ratio. A little bit trickier, that one to think about. Debt to equity, well, of course, debt over equity. Debt is shooting up under a finance lease because we're recording the liability. Equity is marginally smaller because bigger expense initially in the earlier years, giving you lower net income, lower retained earnings. So higher debt, lower equity. This ratio, of course, is going to be higher. Okay, so operating lessor. We've been really talking about lessee so far. Now, what is a lessee? It's the person that actually uses the leased asset. The lessor, of course, is the person who owns the leased asset. Now, this rather depends on whether we're looking at operating leases or financing leases. If we're looking at operating leases, the lessor keeps the asset in their balance sheet. So the asset remains in their balance sheet. Rental income is shown in the income statement, of course, lease payments being rental income coming in, and there's depreciation matching against that rental income through the income statement. Under a finance lease, okay. Now, under a finance lease, there are actually two potential treatments. We have sales type leases and direct finance leases. Now, first of all, we do de-recognize the asset, so the leaseor doesn't retain the asset in their balance sheet. Under a sales type lease, a profit is shown up front, as if you disposed of the asset. Under a direct financing lease, no profit is shown up front. Then, essentially, lease payments are split between interest and principal, essentially. Notice, not only we have a lease receivable on our balance sheet as well. The asset's gone, but we are owed payments from the leasee. So we've got a lease receivable on the balance sheet. that lease receivable will go down by the principal payments that we receive. So the lease payments that we receive need to be split between the interest element and the principal element.